Are they being unfairly targeted in this?
I think the real advantage to the rural sector is that this will stop the artificially high level of farm values in the past, which has damaged that industry. And it's not good for productivity if you're farming for capital gain and not for productive output. I think this is a balancing factor that will be good for the industry.
What about the share trading? Will it scare people out of that industry?
No, to the contrary.
Can you explain
Can I just add to that? Australia's had a capital gain tax since 1985. During the period since 1985, their share market has increased in size 17-fold. Us, without a capital gains tax, our share market's increased 3-fold. So no, it is not going to kill the share market. Quite the reverse. As our export industries thrive, New Zealand will get wealthier and our share market bigger.
Can you explain how the V-Day works? If I've owned a house for 10 years already and sell it for 10 years' time, will there be a capital gains tax able to be levied?
Yeah, sure. First principle is primary residence is exempt. Second principle is it's not retro. If you've owned an asset, any capital gain you make before valuation day is excluded. So you will not pay capital gains tax on any of it. You will only pay the 15% on the net gain in the capital value from V-Day forward after you've deducted your costs.
So if you hold the asset for years and years and years beyond the date of the CGT coming in, you won't have to pay any CGT on it because it won't have been valuation day.
No, it's not the same as the Australian system where they grandparented in all existing properties ad infinitum. It's more like the Canadian system where every property or every asset is valued as of V-Day and all future gain is countable or proportional.
How will that valuation be achieved?
We like the work that South Africa did. It's one of the most recent countries to bring in a capital gains tax. They gave people the option of either taking a standard valuation, which would be easy, say a QV valuation in the case of real estate, or to use one of several ready reckoner methods designed to minimise compliance costs. We've said we will seek the advice of the expert panel on what they should be. An example would be to take an average of book value over a preceding period.
Have you looked closely at the percentage of family homes that are being used as part of business? Because I see that that portion of a family home is taxed. The capital gain on that is taxed. And I know I've heard some very high estimates of that, 102, 103 or
I don't think we've got a number, but it's easy enough to calculate. If you've been claiming losses off a proportion of your family home, 10% of it, because it's used for a business, that 10% is what you'll be paying your capital gain on, forward-looking from the time that the legislation is passed and valuation date occurs.
What sort of revenue you're looking at?
We couldn't put a figure on that, I don't think, at this stage.
Can you just clarify to the question that Patrick Smelly asked? So it doesn't matter, like let's say you set the V-Day at a certain date. It's not only properties that are bought after that date, which are subject to future capital gains tax. It's every property at that date gets a valuation and then you pay capital gains on it after that.
All future capital gains on all included assets, minus the exemptions and minus your costs, so the net gain on all of those assets after the V-Day would be counted.
So if I had an investment property as at 2010, I got the V-Day valuation in 2013 and flicked it in 2015, I'd pay...
Capital gains on the difference between 2015 and 2013.
Thank you.
Yeah.
So it means that for a lot of elderly couples that have had a house maybe for 30 years, they'll pay nothing on the capital gain they've made to that date. They'll only pay it on the remainder of the time after V-Day before they sell it.
Would you give any consideration to not applying the CGTs to savings in a superannuation fund? This presumably applies to the earnings of the funds in KiwiSaver.
No, it doesn't. At the moment, you're already paying tax on your KiwiSaver, so it won't affect that at all.
The earnings of a superannuation fund is capital gains.
They're trading in shares and they're paying tax on it right now, so it won't affect superannuation.
There'll be no double taxation of savings or superannuation funds.
So you're looking to establish the value of every asset this tax might apply to on V-Day, above and beyond property?
Well, that's why we are looking at the example, for example, of South Africa, where they used a range of estimating methods and gave the individual taxpayer the choice of which they used, thereby cutting the compliance costs considerably.
Valuing business of someone's share portfolio at a given day.
Well, that's easy.
Well, that's easy. What about valuing businesses?
Not hard at all.
Valuing businesses is probably the hardest thing to do.
If you look at the South African model, they tackled this problem, and the Canadian model, I guess, so they've got a V-Day as well. They tackled the problem. We're in the fortunate position that we're almost last to the table, except for Turkey, to have such a tax. We can use best practice. It won't be hard. For those that say this is too complex, it's just nonsense to say that New Zealand can't do, with our professionalism, what a whole range of other countries have done over time and done in a straightforward way.
If South Africa can do it, we can do it. The Aussies have had it for 15 years.
30 years now, I think it's the Americans for 100 years, so there's plenty of experience to draw on.
There'll be people who have made their way through a career and they're now earning more than $150,000 and feel pretty good about that. And tonight they'll turn on the television and be told if there's a Labour government, you're going to have to pay more tax. Isn't that unfair on those people?
Well, look, let's have a look at this. I was reading the paper the other day, and this gentleman called Selwyn Pellett, who's an entrepreneur, very successful businessman. He said over the last couple of years he's sold shares and he's made $8 million off it. He didn't pay a cent in tax and he thought that that was wrong. You've heard from Sam Morgan, 700 million, no tax at all on it. What I'm surprised about in my correspondence is the sheer number of people who say, yeah, look, I've got a couple of rental properties, but I'm going to vote for you guys because it's right that I should pay tax on it. I'm paying tax on every dollar I earn from the sweat of my brow. Why should I be treated differently? So I think there's a lot of people that will look at that in a pretty fair-minded way.
But there are people who, I mean, I'm assuming people who are on salaries of, say, between 150 and 200, who actually aren't involved in any of that and just take home their pay, and they have large families, many of them too.
On the salary gap, people in my income position got hundreds of dollars a week back in windfall gains from the national government. Some people, including the Prime Minister, got $1,000 a week back. Asking them to give some of that back to help New Zealand at a time when we're under economic pressure and Christchurch is in crisis isn't much to ask.
You could have arguably been a bit more bold, couldn't you, around sort of some progressive nature to that tax system at the higher income level?
I think we found the balance, Duncan. I think we found the balance. It's a little extra for people at the top. Read Gareth Morgan, see what he thinks about it. He says if you're really earning the big money up there, you can afford to pay a bit more. I'm amazed at the generosity and the broader view that so many people in that income bracket are able to take.
So you didn't consider going a bit broader at the top there?
No, what this does is helps us over that early period of years when the capital gains tax isn't returning a huge amount of money. That starts pretty much as soon as we've got the cuts coming for other taxpayers. I think we've got the balance.
The figures that you had showed you can spend 9% of the revenue on newspaper. Is that a commitment that you won't be spending the capital gains revenue or anything else?
Overwhelming the capital gains revenue is going in a tax switch, so the middle and low income people who missed out on getting much from the tax cuts earlier get a fair share, and the rest on paying down debt. A small percentage of that will go into areas like growth and areas that are priority social expenditure, but it's a very small wedge of where the money comes from.
But
this is not tax and spend.
Is there a commitment to how much you can pay down debt as opposed to new spending?
I'll ask Dave to comment.
Yes, that is a commitment, and it's required in order for us to pay down New Zealand's national debt as fast as the current government is planning to. The difference is that under our plan, which admittedly is tight, two things. Firstly, we are being more sober and conservative on the underlying economic growth rate you'll see in the Bill report. And secondly, we can do it while keeping our SOE assets, and that's really important.
How much more conservative?
Phil's got to catch a plane very soon, so there's time for 2 more questions.
So first of all, we'll check if nobody's had a chance to ask questions, otherwise we'll go back to Alex and over here.
How much more conservative are you, Ben?
Well, for example, at about 15 years out, the Bill modelling gives the CGT about 2.8 billion per annum, and on the Treasury modelling, I think it was about 4 billion per annum for the same period.
But
Treasury growth assumptions. So you can take the Treasury model and feed our CGT model into it. That's where you get to. So there's a significant wedge.
How much revenue was the top tax rate?
Around about $300 million a year. The spreadsheet's in your handout pack. Top tax rate starts at 225 million, goes up 5 years out. It's around 369.
Okay, we've got last question about the traders, share traders, property traders, etc. They're continuing to pay the marginal rate.
Correct. That's right.
Do they pay capital gains tax on top of that?
No.
Okay,
Okay, ladies and gentlemen.
Thank you very much, ladies and gentlemen. Phil has to leave. David.